Good afternoon, everyone. Good afternoon, St. Louis. This is our meeting for the Annual Funds Committee. So I would like to call this meeting to order pursuant to City Ordinance 64457. Ms. Ali, can you please take the roll?
Mayor Jones,
Present.
Comptroller Green,
Here.
Chairman Lane.
Present. And for the next thing, we have a quorum. We're going to approve the minutes. I'll entertain a motion to approve the minutes from October 11, 2023.
So moved.
Second.
All right, it's been moved by Mayor Jones, seconded by Comptroller Green.
Mayor
Ms. Ali,
Jones,
the roll.
Aye.
Comptroller Green,
Aye.
and Chairman Lane.
Aye.
Motion
All right,
carries.
so next on our agenda is our investment update. Before we turn it over, because these are annual meetings, I do like to take the opportunity to let the general public know the purpose of this meeting and what we're here to do. So I'm going to take that privilege and do a brief introduction to this meeting and our time here today. So let me share my screen. All right. Is that visible? All right,
Yes.
excellent. So this is our annual funds committee meeting. It is a committee made up and chaired by myself, the city treasurer, Adam Lane, and also made up of our mayor and our comptroller. What we'll be doing today is just going over the welcome and purpose, which I'll do next, but we're going to get an investment update from our managers. We're going to go over our depositories, our city depositories, as well as approve our broker dealer list. We have some updates to our investment policy, which we'll be looking to approve. After those presentations, I will give a presentation on on some highlights from the HMDA report, the Home Mortgage Disclosure Act report. Share some insights from what we've seen over the past year in lending, both mortgage, small business, refinance, et cetera, as well as present some information on the Banking for Economic Equity scorecard, which is going into its second year of use. I'll take some time to recognize all of our bank and financial institution partners who have been doing great work in moving St. Louis forward over the last year, and then entertain any questions and answers from the group. So brief purpose of this committee, to do all the things that were listed in the agenda, essentially. So the Home Mortgage Disclosure Act was something that was put into place a little while ago just to be able to monitor and look at what trends exist in the lending landscape, because we know that these loans go toward the development of our region. So those home mortgage loans, where those loans are going, the amount and size, as well as small business loans, refinance loans, et cetera. And it's also the official body that approves all of the banking partners that the city is allowed to work with. We also review our investment numbers and approve our broker-dealer list. So this is the body that approves all the financial bodies that the city is allowed to do business with. And we move forward in the year in that way. So just wanted to give, again, a brief synopsis for the public on what we are here to do. And with that, since my part is coming to the end, or this part is coming to the end, I'm going to pass it over to Danny Nelson to give our investment update.
All right. Can everyone see my screen?
Yes.
Yes, we
Yes,
can.
good. Okay. So thank you, Treasurer Lane, and hopefully everyone can hear me and see my screen. I'm going to just start off with a brief investment update and then turn it over to the other managers that manage money on behalf of the city. For the next 3 to 5 minutes, I'll give a brief economic update. If there are any questions or concerns from the committee, feel free to interrupt me as we go through this quick update. So just really briefly, I just want to touch on some current market themes and then talk about interest rates. Over the last year since we last met, since we've had this funds committee meeting, we've seen a labor market that's reached a better balance, and an economy that's really been supported by consumer activity. And even though shelter costs have been relatively high, inflation has made meaningful progress towards the Federal Reserve's 2% inflation target. And so all of this has really led to a resilient economic growth and consumer spending that supports the Fed's softer landing scenario that they're looking for, where we see an economic slowdown, but we don't necessarily see a recession. And so with all of that, the Fed did begin its easing cycle and cut the Fed funds target rate by 50 basis points at its September meeting this past month. So right now, the overnight rate is at a range of 4.75% to 5%. And as a reminder, the Federal Reserve has a dual mandate of keeping inflation and prices in check while also promoting growth in the labor market. And so Fed officials have recently noted that they've really gained greater confidence that their dual mandate is roughly in balance. And so that's what we're kind of showing here in terms of that move. The next thing I want to touch on is the Fed's dot plot. This is just a survey of all Fed governors and where they think the Fed funds rate should be at the end of each calendar year. And the latest survey that came out in September implies another 50 basis points or 0.50% of additional cuts in calendar year 2024, and then another 100 basis points or 1% in cuts in calendar year 2025. And that will bring the Fed funds rate to a terminal range of around 3% or so by 2026. And so in addition to the dot plot and their projection for interest rates, the Federal Reserve did update their summary of economic projections, which you see on this page, where they're projecting positive GDP growth in the next coming years, a slight tick in the unemployment rate, inflation to come down to their 2% target by 2026, and then a decrease in the Fed funds rate, which we've already talked about. And so what does this really mean for the city and the funds that all of us manage on behalf of the city? Unfortunately, yields have continued their decrease, and yields throughout the yield curve, as you've seen here, have fallen anywhere from 50 to 120 basis points over the last 4 months here. And then you can see the shaded area of this yield curve. You can see where rates have been in the last year, basically since we had this last meeting. The yield curve still remains inverted, where 3-month Treasury bills are yielding higher than any other maturity on the curve. But we're slowly seeing the yield curve disinvert, where right now the 10-year Treasury is finally yielding higher than the 2-year Treasury. And that's the first time that's happened in over 2 years. And so as the Federal Reserve continues to cut rates, we'll see the shorter part of the yield curve come down to the point where we'll finally have a normalized yield curve where the yield curve is positively sloped. So yields have repriced lower, which means less investment income going forward compared to what we've seen over the last couple of fiscal years. The majority of the city's funds are invested in the short part of the yield curve. And as yields have fallen in response to actual Fed rate cuts and expected Fed rate cuts, the city will see a corresponding drop in interest earnings in the future. And, the last thing I'll note is that, going forward, it will be really hard to predict how the economy will act. Who knows what the effects from the hurricanes that we're seeing will have, the strikes or near strikes that we're seeing that, represent interruptions to economic activity that can have an effect on the economy as well. There's also 2 wars going on globally with the Ukraine and Russia, and with the Israeli-Hamas conflict that we're unfortunately just celebrating the 1-year anniversary of. And, on top of that, we do have a presidential election coming up next month. But overall, the underlying strength of the economy should hopefully outweigh any of the storms or headwinds that we may see going forward. And so with that, I'll stop there and see if there are any questions from the committee with regards to the economy or the market before I turn it over to the other investment managers that are on the call.
Danny, thank you for that. And as always, just for the general public and those who have a vested interest in the finances of the city of St. Louis, as you all are working with us as managers, can you, given everything that you said, Can you just let the public know what are some recommendations that are coming down the pipeline in terms of our fund management?
I can touch on this briefly. I know we also have another agenda topic in terms of investment policy. I think what we have talked about before, the majority of the funds, at least that PFM Asset manages for the city, are rainy day reserve funds that we manage to a 0 to 3 year benchmark. And as the part of the yield curve is coming down with regards to short-term yields, we have recommended that the city maybe extend the duration of some of its longer term portfolios and maybe to a 0 to 5 year benchmark. So that's one change that may be coming, especially that will help us to lock in some of the yields that we're seeing right now. Even though yields have dropped, as you're seeing here, excuse me, yields are still relatively high compared to what we've seen on average over the last 10 years. Just remember, 3 years ago, interest rates were at 0% and the city wasn't really earning as much. And so we really want to be able to lock in some of the longer term interest rates. The city did earn over $34 million in interest earnings just this past fiscal year. And so even though we do expect interest earnings to come down, we want to kind of mitigate the decrease in interest earnings going forward. I think we also clean up some language in the investment policy to allow for agency mortgage-backed securities. That will also help diversify some of the portfolios that all of the managers manage on behalf of the city, and that could possibly produce more incremental income for the city as well.
Thank you, Danny. I see we have a question from Mayor Jones.
Yes, Danny, given the Feds decreased the interest rates by 50 basis points recently, do you predict any further decreases in the future, or what is your
Yes.
seeing tea leaves there?
Yeah, no, and I touched on that earlier. The Fed is meeting next month. We're expecting at least a 25 basis point cut there and another one in December. They most likely will be cutting rates at least 4 times next year is the market's prediction. So we are expecting overnight rates to come back down from the 4.75 to 5% range that they are right now to possibly, let's say, 3.5% this time next year and down to about 3% by the end of 2025 and beginning of 2026.
Okay, thank you.
Comptroller Green, any questions or comments?
No questions. Thank
Okay.
you.
Okay. Danny, you're good to go.
Okay. And so with that, I know we do have other managers on the call. And just for everyone's edification, the city has hired 4 different outside third-party investment managers to manage different accounts on behalf of the city. As you can see here, PFM Asset Management and Ramirez Asset Management has control over the city's longer-term reserve funds. Loop Capital Asset Management currently manages the proceeds from the most recent 2024 airport bond issue, and SWS Capital Management manages all of the city's other current bond funds. And then the city's treasurer's office still has control of other accounts, such as its general operating funds, federal stimulus money that it's received, as well as settlement proceeds from the Rams and NFL and other accounts like that. And so with that, I know we at PFM Asset Management already talked about our strategy and some of the funds that we manage. So I'm going to skip ahead, and I believe I'm passing it over to Ramirez Asset Management to talk about their firm and what they do on behalf of the city. So Jim, I think if you can get off mute, I think you can take over.
Yeah. Thank you, Danny, and hello to Mayor Jones, Madam Treasurer, Treasurer Lane, and Comptroller Green. Ramirez Asset Management, we are the new kid on the block here. We were just recently hired by the treasurer to manage money. And as you can see from the chart at the bottom half of the page, we are managing 3 portfolios that are tied to the St. Louis Lambert Airport 2024 bond proceeds issuance, and we are managing a small portfolio of excess cash in the treasurer's office. Just to back up for a second and tell you a little bit about our firm. Again, we are excited to be hired, and we're going to work hard to do the best we can. Our firm is based in New York. We are a fixed income specialist. We are a minority firm. We are part of Samuel A. Ramirez and Company, which is a broker dealer. We're an affiliate of that. We currently has, as of June 30th, we manage over $11.4 billion. And to give you an update, we've been growing very quickly. You can see 30% over the last 5 years. Our firm has 31 fixed income specialists and 43 members of the firm-wide. We manage a small portfolio of equity funds, but primarily we manage fixed income funds. I won't spend too much time on the market. I think Danny did an excellent job of discussing the market. We all know that rates are going to go down. The Fed has communicated that very clearly. The question is, how fast will they go down? And nobody really knows the answer to that. And we're all concerned as investment managers about whether there would be a crash landing. And when we say crash landing, we mean, is that going to be very disruptive to the economy and we're going to go into some sort of a recession? And to this date, we haven't seen many signs of that. There are some industry indicators that are pointing out that the economy is slowing, but then we get some conflicting views that the economy may be still growing. So the Fed's trying to manage that, and that will be very instructive to them on how fast they lower rates. So as an investment manager, as Danny said, we want to make sure that we maximize the income opportunity for the city, but still stay within the required investment policies, which are very high grade in nature. And the portfolio that we are specifically managing, we have to make sure that we're meeting the liquidity needs of the investment of bond proceeds, and also pay attention to any liquidity needs that the treasurer's office is putting on this excess cash. So we will try to maximize investment yield under those constraints and within the policy. And again, given that we've only been managing money since the middle of June, and this report is as of June 30th, this is a very short-term perspective, but right at that point in time last year, our portfolio was yielding, above 5% for a yield to maturity basis for the city. And I'll stop there. I don't know if anybody on the committee has any questions.
Sorry, I was on mute. Mayor Jones, any questions? No. Comptroller Green.
I have no questions, but thank you for your report. I appreciate it.
Thank
I
you.
also have no questions.
Thank you.
Thank you so much, Jim.
Thank you, Jim. And then I think next up is Loop Capital. Let me come here, and I believe that'll be Adam Phillips.
Yes, the other Adam, the other Adam on the call. Thank you, everyone, for the time today to speak for a moment about Loop Capital Asset Management. More importantly, thank you for the opportunity on behalf of the full team to manage money on behalf of the city. Specifically, we manage for the recently funded airport bond. The funding was a little bit below 250 million as of the end of the second quarter. That had grown to a little bit above 250 million. And as of September 30th, around 254 million. So in line with the comments that we've heard from the other presenters, the yield environment has certainly created some nice opportunities to grow that pool of assets. Knock on wood that those yields remain where they are. We do agree with the assessment from our colleagues that yields are probably on their way down. Enjoy it while we've got it. So stepping back for a moment, my name is Adam Phillips. I'm a managing director and part of leadership here at Loop Capital Asset Management. For those who are not as familiar with Loop Capital Asset Management, previously we were known as Taplin, Canada, and Hayback, which was originally a women and minority-owned fixed income firm here in Miami, Florida. If you notice that I am not at the office, it's because we are staring down the barrel of yet another hurricane. So hopefully, as I believe Danny mentioned, some potential disruptions to the market. Hopefully not to human lives, but obviously, keeping an eye on things. Loop Capital, as the name suggests, is based and founded in Chicago, centered in the Chicago Loop. It is a diverse-owned firm founded by Jim Reynolds, who continues to lead the firm today. It is one of, if not the largest diverse-owned financial services firm with businesses across investment banking on the corporate and municipal side, fixed income trading, equity research, as well as our department, Loop Capital Asset Management. We joined Loop Capital about 2 years ago. Since then, thanks to wonderful partnerships such as we have with the City of St. Louis, we've been growing nicely. We've recently hit a new high watermark in terms of our assets under management. So now managing just over 9 billion with more mandates on their way. And partnerships like this are integral to our growth plans, and we are sincerely appreciative of the opportunity. Very quickly, kind of how we think about the world. We are a high conviction manager. We are focused on relative value, so finding the mispricings wherever they live in the market. And we focus very much on client partnerships, so not delivering off-the-shelf solutions around the specific constraints, goals, objectives to build portfolios from scratch to meet their needs. So wanted to share those key items, would largely endorse the comments from my counterparts here on the markets. I think the one item I might add as it relates to the Fed is that this rate cut is a little bit different, a rate cut cycle is a little bit different. We're used to those coming about when the economy is in trouble, when we're hearing bad news, when there's job losses. Certainly there are some challenges in the environment, but in a lot of ways what the Fed is talking about now is removing restriction. So they feel like they've made monetary policy a little bit too tight. And they are loosening policy now with the idea of encouraging or supporting a soft landing. Let's hope they pull it off. That would be wonderful. It's not always, it's certainly not easy to do, but I think that is their goal. And what that means as investors from our side, take advantage of yields where they are today, as well as build for the potential for yields to come down a little bit. But again, continue to look for value wherever we find it in the markets. So with that, I want to make sure I'm respectful of time. So let me pause if there are any questions.
Excellent. Thank you, Adam. I will open up to questions. Mayor Jones.
No questions for me.
Comptroller Green.
Thank you. I have no questions.
And I also have none. Thank you. Thank you so much, Adam.
Yes, you're welcome.
Thank you, Adam. And then the last firm we do want to highlight is SWS Capital Management, and I believe John Feaster is on the line to talk about their firm and the funds that they manage on behalf of the city.
Great. Thank you, Danny. I'd like to thank Mayor Jones, Treasurer Lane, Comptroller Green, and I'd like to introduce my firm. We've been managing assets for a number of years for the firm. SWS Capital Management stands for Siebert Williams Shank. We are a woman and minority-owned fixed income asset manager that specializes in customized fixed income for cities, municipalities, corporations, foundations, and endowments. We are actually benefit in the sense that we manage probably the shortest duration or maturity types of accounts for the city. We manage project accounts, construction accounts for the airport, bond indenture accounts for the airport, collateral accounts for parking and for airport, and operating accounts for parking. So as everyone's talking about interest rates, we're really in that sweet spot of 3 to 6 month target maturity funds. Our accounts experience significant cash flows. For instance, we were managing the 05 airport bond issuance that was fully refunded. And as the 2024 airport funds were raised, so we retired the 05 issuance, debt service reserve accounts that we managed as the new issuance of 2024 was issued by the airport. We also manage a fair amount of project funds for the convention center. A lot of our cash flows are focused around the end of your fiscal year, which is June 30th. So for instance, we manage the 2024 and 2022 project fund for the convention center. So for instance, we've had about 25 million in cash outflows for the convention center as the city pays it out before its fiscal end. And then, as I said earlier, we manage a lot of collateral accounts for the parking authority as well. So we are in that sweet spot of managing 3 to 6 months. So as long as the yield curve is inverted, it really benefits these short-term funds, especially in the separately managed account space. So I will stop there and ask if there's any questions, Treasurer Lane or team.
Yeah, we'll open it up. Mayor Jones, any questions?
No questions.
Comptroller Green?
Thank you. I have no questions.
I don't have any either. You all are very clear and concise. Thank you, John.
Thank you.
Thank you, John. And then moving forward, I think we have 2 items for the Funds Committee, 2 action items actually on the agenda. The first is just the broker-dealer approval list. This is something that the Funds Committee does every year where we present all the broker-dealers that the third-party managers utilizes when managing funds on behalf of the city. And so that does need approval from the committee. This page here is showing all of the broker-dealers that we currently use. The ones highlighted in blue are the ones that we want to add going forward for this current fiscal year, 2025 fiscal year that we're in. And just as a reminder, the asterisks that you see, those that are asterisks are either minority owned, women owned, or service disabled owned broker-dealers that we all manage with. It's not just PFMAM, but it's also Ramirez Loop and SWS Capital Management. So we all 4 of us in conjunction would be utilizing all of the broker-dealers that you see listed here.
Thank you, Danny. So just want to note that it looks like there are, and correct me if I'm wrong, 8 new additions.
Yes.
All right. It looks like about 62% of those are minority owned, women owned, or service disabled veteran owned businesses.
Correct.
Excellent. All right. So I will entertain a motion to approve the broker-dealer list.
So moved.
Second.
All right. It's been moved by Mayor Jones, seconded by Comptroller Green. Any questions or discussion? Okay. Hearing none. Ms. Ali, can you please take the roll?
Mayor Jones,
Aye.
Comptroller Green,
Aye.
Chairman Lane,
Aye. Our broker-dealer list is approved.
Thank you, Treasurer Lane, and thank you to the Funds Committee. And the last thing that we wanted to go over, and we've already discussed this, so I don't want to go in depth with it, is the proposed changes to the city's investment policy and investment guidelines. As I mentioned before, we have made some recommended changes. A lot of it is mainly to clean up some language, particularly where there are any discrepancies or conflicts between the investment policy and the different bond indentures that the city has. As I mentioned before, some of the redlined changes that we've made here also allows for the investment in agency mortgage-backed securities, like I said, which can increase diversification, help mitigate volatility, and possibly increase earnings potential. And then there are other minor updates in here that will also help to extend the duration of the reserve portfolios that we manage, and just to provide clarity in terms of the funds that we manage and the restrictions that we have according to the Missouri Constitution and according to the city's policy. So in the interest of time, I'm not necessarily going to go through every different change, but I believe this was provided to you in advance and just going through here. But if there are any questions or concerns with regards to these suggested changes, we are here to welcome any questions that you may have.
Excellent. Thank you, Danny. So I will, again, entertain a motion to approve the updates to our city's investment policy.
So moved.
Second, and I would like to discuss.
Absolutely. So it's been moved by Mayor Jones, second by Comptroller Green. Discussion.
Yes, at this time, I would like Danny to go through those changes. It doesn't appear that they are very many. So if you could take time to go through them, since they are red marked here and not very clear as to what the meaning of all of them are.
Okay, I can do that very briefly. Here on this second page, I think we just wanted to um, define exactly the scope of the funds that this policy covers. And like I said, there have been some discrepancies in the past in terms of do the bond indentures for, or the bond proceeds, anytime the city issues bonds or any of its counterparts or departments underneath it, whether it's the airport or whoever it may be, there has been some discrepancies between the bond indentures and the city's investment policy. So I think some of the changes here just kind of defines the scope of this investment policy and the funds that are under this investment policy. But one of the things I'll mention is that any capital project funds, debt service funds, proceeds of bond issuances, those funds are superseded by the investments permitted by the applicable issuing document, i.e. the indentures or the ordinance. And so that's something that we wanted to clear up here on this page. We do the same thing here on the bottom of page 4, specific to bond funds, just stating that if there is any conflict between the terms and conditions of this policy and the terms and conditions of the bond documents, that the terms and conditions of the bond documents will take control of the funds in terms of how they are invested. Moving on, like I said, some of this is cosmetic. This policy has not been updated in almost a decade. And so, for instance, the NASD, National Association of Securities Dealers, does not exist anymore. It's actually been replaced by FINRA, Financial Industry Regulatory Authority. So just like I said, cosmetic changes that we wanted to make. Some more defining a statement just stating that any percentage limits that we have, maturity lengths, rating requirements, are based on the settlement date of any security that is purchased. Also wanted to define the maximum maturity of any securities is 5 years from the time of placement based on the settlement date of any of the securities that are purchased. Other cosmetic changes, just wanted to make sure that all the managers know that Treasury securities, including Treasury inflation protected securities, what is also known as TIPS, are allowed by the investment policy. For commercial paper, only domestic commercial paper is allowed. Same thing with bankers acceptances, only bankers acceptances from domestic commercial banks are allowed as well. It wasn't clearly defined in the policy, and we wanted to make sure that those statements were included. Once again, making sure that any maturity limits are based on the settlement date of the securities, which is added here. And same thing here in terms of security selection. The 5-year max is based on the settlement date of the security that is purchased. And then in Section D, we specifically list out what is prohibited in terms of mutual funds and equity securities as per the Missouri Constitution, and corporate debt securities outside of commercial paper are also prohibited, which is in line with the Missouri Constitution. So it was not stated that those were prohibited, but we are specifically stating that those are prohibited. I think lastly, we deleted some of the language that specifically pertains to agency mortgage-backed securities. Other types of derivative securities and floaters are prohibited, but agency mortgage-backed securities will be prohibited. Those are securities issued by federal agencies, specifically Fannie Mae and Freddie Mac. You already invest in bullet agency securities, and this just allows you to invest in mortgage-backed securities. And then we do put in specific language for the maximum maturities for those mortgage-backed securities as well. And then just, like I said, just cleaning up, making sure that we have, there's a difference between collateralized CDs and FDIC insured CDs, just adding that in this diversification table, making sure that we have the appropriate maximum maturity and maximum percentage allowed by the policy there. And then the last one is just updating the date that this would be signed. So hopefully, Comptroller Green, that kind of summarizes all of our changes and hopefully gives you a good synopsis of all that we recommended.
And I appreciate it very much. Thanks so much.
Thank you, Danny. Thank you, Comptroller Green, for making sure the public is aware of those changes as well. So I'll do another round if there are any additional questions. Mayor Jones.
No questions.
No. Comptroller Green.
No, thank you. Thank you for the explanation. It's very, very helpful.
Thank you.
No further questions from me. So the motion is live, I guess. So we will, Ms. Ali, can you please take the roll?
Mayor Jones,
Aye.
Comptroller Green,
Aye.
and Chairman Lane.
Aye.
All right.
Okay. We have adopted a new policy. Thank you so much, Danny.
Thank you. And I think that concludes our section of this report and the Funds Committee meeting.
Well, it doesn't conclude the meeting, but it does.
I mean, that's what I meant, our section and our part of it.
No worries. Thank you. Thank you so much, Danny, Adam, Jim, and John as well. We will move over now to my part. So we're going to go through the HMDA report analysis, as well as in the HMDA, it's a long report, and I will say that all the reports will be available on the Treasurer's Office page, so stltreasurer.org, under Treasury operations by end of business today. So that will include the updated investment policy, all of the reports that you've all seen here today, as well as the scorecards and the Home Mortgage Disclosure Act report. So I am going to share my screen once again to let you know what a little bit about what the rest of our time is going to be about. I have a bunch of slides, but I think I'm going to be quick. But yeah, so going into the HMDA piece, I want to focus in on a couple of key areas. We're looking at lending volume by loan type. So again, that is home mortgages, refinance loans, small business loans, et cetera. And then we're going to be looking at those maps that we typically look at to see where that lending happened in the city of St. Louis. And we're always, we always want to make sure that we're focused on equity and what does equitable lending look like in our city, because we know that a rising tide lifts all boats, and we want to take that approach, and we want our institutions that do lending in the city of St. Louis to take that approach too. So we're going to focus in on what does lending look like for low to moderate income tracts, which can have their challenges, and I have some very exciting data. Well, exciting to me, exciting data to present on that. And with that, I look at the ratio of originations to applications, both overall and within the LMI tracks too. So here's what we found. So this is the overall report. So total loan volume, you see the three banking institutions that came in top three for loan volume. And overall, so this past year, 612 loans issued among the 16 banks, and you can see the totals there. That represented about 33% decrease in loan volume and 42.5% decrease in dollar amount. We just got the economic outlook and what rates have looked like for the last year. So it's no real surprise that with high rates, lending tends to go down, as well as when there's low stock added into the mix. So with the mortgage volume, and we'll see a big chunk of that being in the refinance market, because when rates go up, you're not going to refinance for a higher rate for the most part. So yeah, so we'll see that as well. So in terms of mortgage volume, 358 loans, which represented about a 33% decrease in the volume, and then a total volume of 105 million, which was about a 42.5% decrease in that amount too. On the home improvement and refinancing side, again, the numbers speak for themselves. So we're seeing decreases across the board. Again, high interest rate environment makes it tough for lending. But we did have lending volume. It was just that it did decrease. I think with the economic outlook and rates going down, I would assume that a year from now we're going to see an uptick in the refinance market. Depending on where that dips, especially for those homeowners who purchased within the last few years. For the 16 banks and financial partners that the city works with, here's the top 5 for loan originations from applications. So what we did was look at, and my team, and we got the HMDA report, looked at the data tables, and we wanted to see how good, this basically just says how good how good of a job are our banks doing approving these loans that come in. So these are those approval rates for those banks, and these are the top 5. So this is not by volume; it's really just by rate. So we appreciate those banks that are doing a good job turning these applications into originations and making it possible for folks in the city of St. Louis to be homeowners for the first, second, or third time. I also want to note that these are minimum 10 originations, and the way that we calculated this, so when we get the HMDA report, it is a snapshot in time. So we don't look at total. So we'll have 3 numbers essentially. So you have the denials, the originations, and then total applications. So there's always going to be this number that's left out, which is still in transit. So it's neither a denial nor an origination. So we sub those out as well. So this is just looking at denials, approvals, and looking at what those rates are. So congratulations to these bank partners. The next one, which is my favorite, is looking at what these rates look like in low to moderate income areas. So I'm going to orient you to a few things. So if you look at the overall rate right there, these are the top 5 banks in terms of origination percentages or approval percentages just by low to moderate income census tracts. So you can see Enterprise and Midland up there at 100%. This is minimum 4 originations, but at 100% for their approval rate for LMI home mortgages. The differential number, that 21% and that 7%, that is actually the number or the percentage comparison from their LMI approval rate to their overall rate. So what this is saying is that Enterprise Bank and Trust has a 21% increase in their approval rate over just their overall rate. That was interesting to see because we would tend to think it's the opposite. You know, we know that there are challenges with lending the LMI populations and LMI tracks, but we do have banks and bank partners that are doing an excellent job of this. And as I was telling all of our bank partners on our one-on-one calls, I think this is a great indication of just what the ecosystem looks like. And we know it's going to take all of our bank partners and the efforts of our community partners, our city leaders, to make sure that when we're increasing that housing stock and that we're working with and for the community to make this ecosystem possible. So going into community reinvestment, so looking at small business loans, a bunch of numbers here, but I do have it highlighted. Just want to point out some of our bank partners that are doing great work in the small business loan space. And it's not just the HMDA report does a great job of breaking this down by the loan amount as well. So it's not just what are those big $1 million loans or $500,000 loans, but we know sometimes those small businesses, a loan of $2,000, $50,000 can actually make a huge impact on that business and get our city where it needs to be. And we know small businesses are the heartbeat of our community. So we want to thank our banks and bank partners for committing to our small businesses during this time. The next floor slides kind of look at that map. So I know that not all LMI census tracts are created equal, but we know what our city looks like, and we've seen these maps a lot. So even with the high interest rate environment that we're coming out of, and hopefully we have a soft landing from that, but with the high interest rate environment that we're coming out of, what we essentially want to see, and we say this every year, we want to see a nice green covered city. What that means is that all areas of the city are getting the lending and the investment that they deserve, because that's what's going to to move our city in the direction that we want it to go in. And I'm happy to see pretty good green coverage all around. Of course, we still have our areas that are white that need a little bit more investment. And again, that's going to speak to the ecosystem of work and the network of work that we have to do. But on the home purchase loans by amount right here, especially in a high interest rate environment, it's good to see that relatively even coverage. This is the refinance map. This is actually kind of good to see. So we know that there are certain areas where, yes, there was more refinancing, but in a high interest rate environment, it's going to be low anyway. And we know that LMI populations, in terms of refinancing, when rates are higher and those refinancing opportunities don't exist or not present, it's just gonna be where it is. So we acknowledge that. So this is on trend with what we expect, but I don't think this is by any chance a negative outlook on what we saw in the last year. Just more so how it's responded to the economy. Home improvement loans, similar. If I have to pull out a loan, especially for a home improvement project, of course, I don't want to put off that project. However, it's going to be heavily determined by rate. So with home improvement loans, refinancing loans, we expect to see those maps look similar. And then lastly, by total amount. So this relates to that first map. But again, I won't belabor the point. We want to see good green coverage. Okay. The last piece that I will say as we go into the next, the last piece I'll say, so in terms of originations and total LMI loan volume, so we saw 75 loans, which were 12% of total home loan originations. And then I just also want to look at that rate. So not just the number and volume, but at what rate are we approving? When people are putting in applications, are they getting into these homes? Are they getting these mortgages? So with an overall approval rate for all areas at 61%, that was actually a 6% drop from the previous year in the overall rate. But when it came to LMI tracks, we actually saw an uptick of 5%. So healthy to see that LMI lending is intentional. And when I get into the scorecard, you'll see just the intentionality that our banks and bank partners are putting into making sure that communities who have traditionally been marginalized from owning homes in our city, making sure that they're putting specialized products and programs to change the face of lending in St. Louis. And then this last slide on the HMDA report is this is the same slide as last year, but this is just, I propose this as what we're working towards. So, and what we're looking to change. So these are the census tract numbers as of the 2020 census. And we're looking at, again, owner-occupied units and rental units when it comes to our LMI census tracts. And then middle and high as well. And we want to make sure that these numbers have a more equitable trend as we look to our next census. All right, well, let me stop there and I'll see if there are any questions before I continue, because I'm going to shift into our scorecard review.
No question, just a comment. I want to thank the planning department for putting this together again. It looks like while our numbers are improving a little bit, I would forecast that the numbers will be a lot better next year because of some of the programs that we put in place, particularly the some of our ARPA funds that have gone towards building new homes in North St. Louis, and our partnership with several CDCs to build new homes and rehab homes, as well as our Home STL program that provides up to $50,000 in home buyer assistance in low to moderate income census tracts. So we will hopefully see much better numbers with the efforts that we have been doing to improve homeownership in the city.
Absolutely. Thank you, Mayor Jones. And I definitely think that, and like I said, it's an ecosystem. So with your administration putting dollars behind those words as well, and then moving forward with those projects, and now with our bank partners creating programs, sustainable programs that get people ready for those homes, it's a perfect marriage. And they've got some great team members in the lending area who are making these mortgages happen, as we can see. And yeah, it's only up from here.
Yeah, and our home STL program is already oversubscribed.
Wow,
We've closed on the first 10 already, so.
amazing.
Mhm.
Thank you, Mayor Jones. Comptroller Green.
Thank you for the report. I commend you, the planning committee on putting it together. I'd actually like to ask for the summary report that you have on screen. I do have the detailed report, but the summary report, I would love to get a copy.
Absolutely, will do. I pulled out my favorite numbers. So.
And
All right.
thanks again.
So we will continue. So the scorecard, I won't talk at length about it this year like I did last year. The last year scorecard is on our website. What it is, I know a lot of municipalities talk about we want to be committed to economic justice, and this is how we want our partners and entities in our city to do the same, but don't often outline what exactly that means. So this is a measure to put a qualitative and quantitative tool in place to be able to do just that. So our banks know what we're asking of them and what we are prioritizing as a city, and how they are partners in that place. So the scorecard is in its second year. I want to thank my team, so the entire Treasury Department, for helping to score these. We spent a lot of time and energy in that. I want to thank all of the banks who met with us and took time, because I know it takes time to provide all the information that we asked for to be able to deliberate and give our scorecard recommendations. So thank you for being willing. And also, I really want to thank our bank partners for showing up to the table. So it wasn't something that they said, well, we don't really care about the scorecard or what it means because we're going to keep doing what we're doing, but really investing in the scorecard and taking a deep and introspective look at their numbers and where they want to be. We understand it's a snapshot. We understand that next year, because of economic circumstances, looks different from this year. But they have really, all of our bank partners have really signed on to this commitment that we have asked of them. So I won't go into I will go into one particular bank scorecard because I needed an example. So hopefully they don't mind that. But what the scorecard is, just for edification, it's a way to look at all of these things comprehensively. So we look at the diversity both at the leadership and board level, but also the client-facing level. So we want the greater St. Louis public who interact with our banks and bank partners to see that there is representation of the city in there. Equitable lending, that's the data that we pull from the Hunber report and all the information that I provided around what are LMI rates compared to, or approval rates and origination rates compared to their total book of business. And then lastly, with customized products and programs and the community focused empowerment, how good of a job are our banks doing of creating tailored and customized products that undo years of redlining and years of keeping marginalized communities out of the banking space in a healthy way, and bringing them in and creating tools that promote economic development for all. And then lastly, how good of a job are they doing being a partner to our St. Louis agencies and creating this ecosystem of banks, of financial institutions, of community programs, and municipal government, all in efforts to do what we can to make this city as great as possible. My chief of staff said I should have deleted these, and she was right, because I don't really need them because I already talked about them. But I will use one scorecard. You're right, Shirley. One scorecard as an example. So you will see 16 of these. And again, I thank our banks for doing 16 meetings with me and my team for being on those meetings as well as we talked. But in those meetings, we look at a lot of data. We go through a lot of paper. Virtual paper, digital paper, to come up with the things that rise to the top for those scorecards. So if you look in those boxes, you don't see everything that a bank does, but we talked about what rose to the top. So you'll see the diversity numbers, and we asked for those hard numbers. And some of our banks said, well, we don't really provide that. I'm like, well, we need it. and they came to the table and they actually gave us those numbers. So we appreciate it. So we put that out there, and they were willing to have us put that out there as well as having conversations about what it takes to get to that next level. So every single bank that we spoke with said, yep, if it's not an A, we don't want it. So what can we do to get to the next level? And I appreciate that commitment. But what you'll see is the overall letter grade. You'll see how the bank did last year, what their leading category is and their trailing category is, and a little bit of information about why they received the grade that they did. What we will be putting together and putting online in addition to the scorecards, all of our banks have amazing programs and partnerships that they're partners that they're working with and programs that they've instituted for commercial banking and lending, and we'll be compiling all of that into our report so that the greater community knows where to go. Just like we have the lending approval numbers, and if I am someone supporting folks around buying homes in LMI areas, I know that, you know what, I should probably knock on Enterprise's door or Midland's door because they're doing a really good job based on those rates. So we're not just taking in a bunch of data to take it in. We want to use this. We want to use this data and have it be effective for how we move forward and how we support people in the most effective way. Some of the scorecard aggregates, you'll just see the overall averages by category. So most of the categories averages B, leadership diversity, we need to work on it. So that was a C average. And then you can see just the total, and this will be available online, so we won't spend too much time on it. But you'll just also see the totals of each category by score. So you can see there in leadership diversity, we had 9 C's, and you can also see how many banks scored those different types of grades. So 6 A's, 8 B's, and a C. A couple of things that I'll say just to close this part out, but what I've been seeing in a lot of the trends for that customization of those products. So we've seen a lot of dynamic accounts. So banks are doing a lot of things to either have match savings accounts, fee-free accounts, accounts if there are low transaction fees, being able to eliminate those, eliminate any overdraft fees. So we've been seeing a lot of that, as well as responsive loan products, both for LMI communities, second chance borrowing for those with low credit scores or a more troubled credit history. And one of my favorite things, just our bank partners being able to buy back and replace a lot of these predatory loans that are out there, or high interest car loans that folks might have, as well as offering a slew of emergency loans for folks that have those unanticipated emergencies. Because for someone, a $500 emergency 1 month out of the blue could be the difference between them being in their home next month or not. So we appreciate our bank partners for doing that, as well as the many CDFI investments and partnerships that are happening too. I put this slide in here personally, specifically for you, Mayor Jones. I know this was a question that came up last year, so wanted to speak to that. So our snapshot of last year at this point, just looking at what our local investments were. So what's the money that we're putting into our local banks? So we can't just say, all right, yep, you're doing great work and you're a partner in the economic justice space, but we also want to make sure those deposits stay the same. So as of this time for last year, we were about 47% of our investments were in our local bank institution. Same time this year, it's over 50%. And again, what does this mean to the general public? That's $805 million that our bank partners can use in conjunction with what we talked about in our priorities to reinvest in the St. Louis community. We have a program called the College Kids Savings Program, which I appreciate. So I did want to take this opportunity selfishly to thank all the banks that have been great partners in putting on programs, holding accounts for our college kids, donating their time. And I know not all of the banks are up here, and so I apologize for those who are left off. We'll make sure that when I put this online, we have everyone updated. I'm leaning on you, Christina, to make sure I have all those banks on here. But I do want to genuinely say thank you, because you don't have to do it, but you choose to do it, and you choose to do it not because of me, not because of Mayor Jones, not because of Comptroller Green, but because you believe it's the right way to invest in the future of young people. So I'm always grateful for partners who believe in that and choose to do that and choose to have that as a value for their institution. Last bit of gratitude I want to give, first Christian Alberg from the Planning and Design Agency for fulfilling my many data requests and follow-up requests to get those numbers absolutely right. I want to thank my entire Treasury team, and I will say them by name because I do appreciate them and want them to know that. So Christina Bennett, Benjamin Janiti, Dusty Cushman, Angela Henderson, and Chrissy Fitzpatrick. So thank you all for all the time that you put in. So this group, Christian gave us the data, and the banks gave us the data. This group went through every single bank submission, scored every bank. We had conversations about every single bank and what was submitted to comprise these scores. So a lot of thought, time, energy, and effort went into this, and I want them to know that it is truly appreciated. Cool. All right, so that is where I will stop. I will open it up to any questions, and I'll start with Mayor Jones.
So will you put the scorecards of all of the banks online?
Yep, all 16.
I'm really interested to look at them. Yeah, and thank you for taking my hint on the on local investments. That was really helpful to see how we're investing locally. So thank you. And I know this was a labor of love, and I appreciate all the hard work that you and your staff did to have individual scorecards for our banking institutions. That's really going to be helpful as we go further down the road and take a look at who we're doing business with and what kind of business they're doing and what their commitment is to diversity, equity, inclusion, and making sure that not only are they talking the talk, but walking the walk. So thank you.
Absolutely. Thank you. Comptroller Green.
Same here. I just want to say that I appreciate all the hard work that was put in to the presentation. It was well done. Thank you and your staff.
Thank you. All right, so I do believe, let me find the agenda again, but I do believe the last executive, the last piece of business that we have is just to approve our city depository. So we've approved yeah, I think that's the last thing. Let me. It is. All right, so I will entertain a motion to approve our city depositories. I will also bring up the list of city depositories, just in case.
Is Paramount a new one on the list?
No, so this is their second year.
Is there second year?
Yeah.
Okay.
So technically new, yeah, but brand new as of last year.
Okay. Okay, I move that we accept the list of city depositories for fiscal year 2025.
I second.
It's been moved by Mayor Jones, seconded by Comptroller Green. Ms. Ali, can you take the roll?
Mayor Jones,
Aye.
Comptroller Green,
Aye.
and Chairman Lane.
Aye. All right. So we have approved our city depositories. All right. Any new business? I don't think we have any. No. All right. Well, I want to thank all of our partners for their time. I want to thank you, Madam Mayor and Madam Comptroller, for your time as well with our Funds Committee meeting. And that's all we have. So if there's nothing else, I will entertain a motion to adjourn.
So moved.
Second.
Ms. Ali?
Mayor Jones,
Aye.
Comptroller Green,
Aye.
and Chairman Lane.
Aye.
Thank you.
All right, we are adjourned. Thank you all. See you next year.